There's various ways to trade the markets, obviously, and our guest today, Ken Calhoun, is here to talk to us about how he does this. So Ken, talk about why you have a lot of open positions in a lot of stocks at any given time.
Okay, good question, and it's great to be here, Tim. One of the strategies that I've used, I've traded over $5 million worth of equities and ETFs last year, is I will put on several dozen what I call test trades or pilot trades, anywhere up to, say, $400 or $500 worth of capital, throwing a lot of small darts at the market with the goal of only being 30% right in position, or scaling into the winning positions, so that way I can maximize my opportunity to get in as many different breakouts, because we cannot predict which ones are going to go. So I like to put on a lot of small share trades, blanket the market, put on those orders, the buy stop orders before the market opens, and that way once they take out new 2-day highs for longs or drop under 2-day lows for shorts, I automatically get filled. So it makes it very easy. I'm not manually tapping out dozens of trades. I put in all these buy stop orders, so it automates it for me for those that are in the process of taking out new highs above previous day's highs. All
right, so you have a lot of small positions open, and the ones that are taking off for that day or the opportunities, those are the ones you're trading. And then do you close them out at the end, before the end of the day?
The ones that take small stops, I try and keep my day trading stops to under 20 or 30 bucks as a target. So with 10 or 20 shares at a time to start, you can do that. With swing trades, though, if they close near the high, I'm likely to scale into that or double that position. A high volume closes, I'll add to the winners and keep those as swing trades. All my trades start off life as a small share swing trade, and then I double or scale into the ones that are making new breakouts to add to or leverage a winning position. That way I can take many, many small hits and still come out ahead. I make profits in my trades by selectively holding the ones that are in the process of taking out 2-day highs into the close. So.
All right, so I know you monitor all your positions at one time so you can see which ones are moving, but why not just monitor the price of all the ones you're interested in and then just trade the ones that are doing what you want them to do?
Oh yeah, good question. What I'm looking for, things like breakouts beyond previous day's average trading range or previous day's high or low, and that way I scan through all of the charts manually. It's a lot of work each day before the market opens, and then I put in all my buy stop orders with my broker interface before the market, and that way, so I'm doing that in a way, I'm in the market for those that are taking out highs and lows. For anything that's inside the previous day's range, I don't trade. And also, it's another great tip, number one tip for traders, don't trade end days or days in which the NASDAQ or the S&P or the Dow are inside previous day's high-low, because institutional money flow and high-frequency trading and dark pools and all that typically don't activate until you're outside of previous day's high-low. So I do that with the stocks and the ETFs I trade as well.
Ken, thanks for your time.
Well, thanks so much for having me, Tim. Appreciate it.
You're watching the MoneyShow.com video network.